These quarterly results are often my favorite times when it comes to following Tesla. Not because of the numbers themselves or even what we get to learn, but to watch everybody's reaction to the day. The expectations going into the call become very clear, and I can get a great sense of the sentiment around Tesla from both Wall Street and retail. This time around, we have many Tesla bulls working overtime on the spin team, providing some hopium for those that are coping right now, and we have many investors and fans that are disillusioned with Tesla, disappointed, frustrated, selling shares, and venting about Tesla's missteps. Some of you may be a bit surprised with what I have to say, but first, we did get a teaching moment with that $5.9 billion non-cash tax benefit. This was for the release of a valuation allowance on certain deferred tax assets. I didn't really see anyone explain this, and VAs, valuation allowances, happen all the time with startups, so it's worth a few seconds to share a hypothetical example. Let's imagine Tesla is a startup again and loses $100,000 in its first year, and its tax rate is 35%. Tesla can carry forward this loss to offset future taxable income. It's this loss that actually then becomes a DTA, or a deferred tax asset, which in other words is just future tax savings. You wouldn't debit the DTA entry by $100,000 though, you need to multiply by the tax rate, so in this case $35,000 becomes your DTA, and you would credit the income tax expense for $35,000. Then Tesla's accountant tells Elon and the board that Tesla probably won't ever have any profit or taxable income to offset, meaning Tesla could not carry forward that loss. Tesla would then set up a VA, or a valuation allowance account. Remember when Elon said in the early days that Tesla had optimistically less than a 10% chance of succeeding? The accounting isn't critical here, but if you're wondering, it would be debit income tax expense for $35K and credit the VA to reduce the DTA. Then in the future, Tesla actually earns taxable income and makes a profit. Now they can use that loss to offset their tax bill. This entire premise is, however, based on if it's more likely than not that some of the tax benefits will not be realized, then you would set up the DTA valuation allowance. This is very subjective and why timing can be flexible and a way for some companies to massage their earnings. This is clearly a one-time item, and it's thus backed out by Wall Street since it has nothing to do with Tesla's core business operations. With that mini lesson out of the way, it's time for me to say what may be tough for some Tesla fans to hear. There may be more pain ahead. It's pretty simple, really. Tesla previously guided to a 50% CAGR that they've hit for 3 years now, and yesterday they clearly said that was not going to happen in 2024. I've said many times before, Tesla's guidance was not 50% every year, but in the long run, the plan was to average out to that rate. For that to remain true though, Tesla is now going to need massive growth in 2025 to 2027 to get back on track with that target. Let's say Tesla grows deliveries 17% this year, which is what Wall Street is expecting. That would be about 2.11 million deliveries. So for Tesla to get back on track in 2025, it would then need 3.79 million deliveries, which would require an 80% growth rate after exiting 2024 with that 17% growth. It's really not hard to see how this 50% growth gets out of reach very quickly, and Tesla just admitted that this is the year it happens. So obviously Wall Street is now adjusting their forecast because remember, the market really looks about 12 to 18 months ahead. And with significantly lower expected growth, especially if interest rates remain higher for longer and the consumer tightens up even more, price cuts may still be in Tesla's future. All of this to say, I would at least be prepared for more pain ahead with Tesla stock this year. Tesla dancing around the guidance and margin questions for this year only brings more uncertainty for Wall Street, and we know they hate that, so Tesla is going to be punished for it. Plus, there are other details contributing to the downward EPS revisions on Wall Street in addition to the lower expected growth. Tesla's CFO said a change in deferred tax accounting would result in Tesla's tax rate being closer to the S&P 500 rate of 20%, which could end up in roughly a negative 10% hit to earnings per share going forward. And yes, I know Tesla's auto gross margin ex credits came in above expectations, stopping the fall that started in Q1 Q1 of 2022 when that figure sat at 30%. It did stop a quarter-over-quarter sequential decline for the past 4 quarters. But the question remains, is this number going to stabilize and tick up, or will it just be a pause before further reductions? Honestly, the jury is out. For the full year 2023, Tesla's gross profit is down 15% year over year. Operating income down 35% year over year. Free cash flow down 42% year over year. Net income down 23% year over year. These are just the facts. It obviously doesn't mean the growth story is dead, but to expect Tesla to maintain a very high valuation multiple through this time is just not based in reality, no matter how bullish you are in the long term. I'm sharing this because I've seen many Tesla bulls painting these earnings as great or even exciting, and the way I see it as a whole, they're just really not. Yes, it's true that 2022 was a banner year for Tesla and the comps were astronomical, but when a company pulls off numbers like Tesla did in 2022, the expectations then shift upward. When Tesla was printing 33% auto gross margins and nearly 20% operating margins, that was what I would classify as exciting. Those days will be back, but patience is going to be required. So for the short term, the question then becomes, who's to blame? Yes, interest rates are a big factor, but let's be objective here. What if Elon and the board put the next-gen vehicle ahead of the Cybertruck these past few years? Could Tesla have maintained its 50% growth in that scenario? It's certainly a fair question to ask. We know Elon was banking on FSD being solved, which would have rendered a compact, non-robotaxi vehicle somewhat irrelevant, but the fact is, Elon's been wrong on that so far. And yes, Cybertruck first may help margins more and sooner than a compact would, but was one, if not two, stagnant growth years worth that trade-off? What about if Elon and the board would have started advertising much sooner? What if they would have been more public fighting back against the FUD years ago? They clearly admitted on the call that they are aware Tesla has an awareness problem. In big markets like Japan and others globally, the Tesla team is now admitting what those of us who talk to other humans outside the Tesla bubble have understood. Tesla is a special company, but the average person has been duped into thinking otherwise. Tesla has had over $20 billion in cash sitting idle now for a while. They could have taken $500 million, hired some digital marketing savages, and went to town educating, FUD fighting, and advertising, but they didn't, and now Elon and the execs are admitting it's a problem. But it still sounds like they're pretty reluctant to spend money here. I'm of course all for spending wisely and Tesla staying true to its hyper-efficient capital allocation, but the guys on the call are engineers and finance guys, not the marketing team. They're still not fully on board with the power of digital marketing, but they will realize this year they need to be in order to help bridge the gap to everything else that Tesla is working on. I think most of us here would agree that the public perception of Elon and Tesla has been distorted by mainstream media. We all need to ensure our family and friends are equipped to consume information without the glaring media bias that so many still can't see. When Elon simply explained why he has some concerns about growing an AI juggernaut without enough control to be influential, so many articles started painting it as Elon demanding another huge payday. There were over 50 sources covering this story, and the left-leaning political articles focused on Elon's influence, and the right-leaning articles were focused on the dual-class structure. This type of information and source aggregation is made possible by a company I'm eager to support in this day and age, Ground News, the sponsor of this episode. It's a website and an app developed by a former NASA engineer to clearly highlight the biased distribution and political affiliation of each source based on ratings from 3 independent news monitoring organizations. In seconds, I can compare every headline from every source reporting on a story from the left, center, and right, and each story has tags showing the factuality of the source, the ownership of the source, and even better, I can go read the full article from any source with just one click. With Ground News, you can customize your own feed with whatever topics interest you. I, of course, have one with just Elon and Tesla. When you subscribe, you not only support me with Electrified, you're also supporting an independent platform trying to make the news more transparent. another mission I'm fully on board with. You can go to ground.news/electrified to subscribe through my link for as little as $1 a month, or you can get 40% off unlimited access to the Vantage subscription, which is what I use. The link is in the description below. All of the things we say about Tesla being so much more than a car company, how the competition is stuck in neutral, losing billions on EVs, scaling back their EV plans, quitting even trying to solve for full autonomy, etc. The problem is, it's just a fact that Tesla's current financials only support so much of a valuation. Whether you agree or not, projects like FSD, Optimus, and Dojo are going to remain in prove-it mode for the markets until Tesla proves it. In Wall Street's eyes, Tesla cannot sustain a PE over 60 with growth between 10 and 20%. The market has been expecting Tesla to pull rabbits out of hats and maintain that 50% growth through any type of macro environment, but for right now, there are no rabbits to be had, so it should be pretty obvious that with growth expectations plummeting for the timeline that Wall Street considers most heavily, that Tesla stock is going to get hit pretty hard. Then you factor in overall bearish sentiment and Tesla swings always being exaggerated with the massive amounts of leverage and derivatives trading Tesla, and an overcorrection is certainly possible here. There are two more areas I want Tesla bulls to be sober about going forward. One is Dojo. We've known for a while Dojo has been a long shot. That's nothing new. Elon even mentioned that Tesla is working on future versions of Dojo and that Dojo is up and running and training jobs, and they're still scaling it up. However, it was clear as day that Elon wanted to emphasize the risk aspect of this project more so than the reward. I'm all for honesty and transparency, but this commentary probably wasn't ideal for recruiting purposes alone. I am glad, however, Elon took this tone because I've seen plenty of Tesla fans talking as if Dojo is a foregone conclusion to yield trillions in valuation for Tesla when it operates like Amazon Web Services. Elon said plain as day Dojo does not have a high probability of hitting this type of huge payoff. Personally, I'm great with Tesla taking risks like this, trying to integrate vertically, getting learnings from doing so, and if they spend a few billion over a few years and it doesn't materialize, it's not ideal, but so be it. Risk taking is what got Tesla this far, and no company, not even Tesla, is going to bat 1,000. The final area I want us all to have sober judgment about for the next 1 to 2 years is COGS and margins. In the past year, Tesla's driven down the cost of goods sold by about $3,300 per vehicle, or 8.5%, which has of course helped to offset the price cuts. But Tesla is now hinting that this $36,000 COGS is potentially a lower bound limit for COGS reductions. So yeah, Tesla can continue to play this penny removal game, but they're much closer now to being out of moves from a COGS reduction standpoint than they've ever been before with their current generation of vehicles. It's also fair to ask the question, how much of this COGS reduction was driven by Tesla's manufacturing genius, and how much of it was driven by major reductions in commodity prices falling back down to earth? I, of course, would never doubt Tesla's agile manufacturing, their relentless innovation and supply chain negotiation power, etc., but costs can only go down so far, and it sounds like Tesla is close to the lower bound limit, meaning Tesla has less flexibility with future price cuts to not harm margins. So at this point, you may be thinking, oh geez, is Dylan a bear now? If you know me, you know the answer to that, but I do want to be objective, fair, reasonable, and as always, try to set realistic expectations going forward. While I stand by everything I just said, what I'm about to say I believe is orders of magnitude more important to Tesla's future. Remember when I mentioned Tesla advertising more to bridge this gap to the other things they're working on? Well, those things are things that have never been done before in the history of mankind. For us to expect that Tesla just solves them in the short term isn't realistic or fair to anybody. Elon definitely deserves some blame for publicly setting terribly over-enthusiastic timelines, but go watch an FSD12 video. I'm still trying to suppress my excitement the best I can until we see it operating outside of California, but if the drives look as smooth and human-like as the early videos have in California, this release may actually finally be worthy of a term like a breakthrough. Yes, there are still bugs and instances where it needs intervention, but given how much faster the rate of progress should be, we may be in for a very exciting year of FSD development. And is it really any surprise that other automakers don't think it's real based on Tesla's conversations with other OEMs? These same OEMs that have had zero success in their autonomous efforts and have all backed off full autonomy to now just focus on level 2 ADAS. The unfortunate reality is that we can know the truth. Tesla is the only company that has any real chance at solving generalized autonomy anytime soon, but until they take responsibility from the driver or see a massive uptick in the take rate, Tesla stock is not going to be rewarded for this progress. A time is coming when Tesla figures this thing out. Maybe it's 2025, maybe it's 2028, but let me be clear, Tesla will be the first to solve it. No one else is going to quickly follow unless they license it from Tesla, and I will continue increasing my share count confidently until that time comes. Not financial advice, because I have time on my side and not everybody does. Like I always say though, the best things in life are worth waiting for. It's a similar story with Optimus. I wish someone would have asked about the timeline for Tesla deploying Optimus in its own factory rather than shipping one or making first deliveries. I know people are excited. Elon said Tesla has a chance to ship some units in 2025, but the world is viewing this guess from Elon in the same lens they view Elon's comments about FSD timelines. Given the back and forth between Elon and the team on the call, it sounds like even the team is skeptical that Optimus is ready for scale manufacturing with all of the safety precautions in place to prevent from malware attacks, and also doing real useful work reliably for an outside company by next year. I'd have to say, wouldn't Tesla want to use the first few thousand bots in their own factories before shipping to other companies? Tesla is not a small sub-billion-dollar company like Figure that needs a big OEM deal for market perception, financing, etc. Tesla should keep the bot in-house for early testing and begin replacing its own workforce to save labor costs, reduce injury rates, and so on. So yeah, Optimus is making incredible progress, but I'm not going to expect Optimus deliveries to third-party companies in any sort of scale that moves the needle next year personally. If it happens, I'll be pleasantly surprised, and of course, I'm rooting for it. So with all of that out there, let me just run through some other things that are also true. Tesla has the most pristine and impeccable balance sheet in the auto industry, and it's also in the top tier of big tech companies when it comes to net cash relative to total capital expenditures and operating expenses. With $29 billion in cash, we know Tesla has an incredible capital allocation track record, and this sets Tesla up beautifully for both ample reserves and ammunition to go on the offensive when it thinks the time is right. Tesla's energy profits are up to $1.14 billion for 2023, up from $288 million in 2022, up almost 300%. Lathrop should have a second production line up and running by the end of this year, roughly doubling Megapack output capacity. We said at the end of 2022 that in 2023, there was a chance Tesla Energy does $1 billion in profit, and what do you know? Here we are. Depending on revenue recognition, this figure could spike to over $2 billion for 2024. These figures are with Tesla Solar being essentially a complete dud this year, with deployments down 36% year over year. So if Tesla ever cracks the code with the solar roof and interest rates come down, that's just more upside. Tesla generated $2.06 billion in free cash flow in Q4, even after all of the price cuts and increased capital expenditures. This was the best quarterly result since Q3 2022. Tesla's services and other business has gone from losing $500 million in 2019 to making $500 million in 2023. As Tesla's fleet grows, its part sales grows, used vehicle sales grow, supercharger profits grow, merch sales, etc. And 2023 wasn't just incremental growth, it grew 138% compared to 2022. By 2025, this could be another business line driving over $1 billion in annual profits for Tesla. Overall, it may have been a down year for Tesla, but they still grew total revenues 19% in a pretty challenging economic environment. It's not the growth we're used to, but it is still growth. And most importantly, Tesla is hyper-focused on FSD and Optimus, two business lines that the world has never seen before and with which the financial implications are impossible to know. I have no idea how much value Tesla stock should be given right now for Tesla's work on these projects, but quite frankly, I really don't care because I'm in this for the long run and for what Tesla's business will look like in 2028, not 2024. What I do know though is that Elon and the Tesla team read the internet comments. They see the articles about Tesla's failures and their laughable bets on robots. I have a strong conviction this is going to light more of a fire in Elon and the team to relentlessly pursue capital deployment excellence and rapid innovation to prove all of the doubters wrong. Everything we've known for years about Tesla is still true. Tesla has the best talent, the most exciting roadmap, the best culture for innovation, the best leader to light a fire under the engineering teams and to take big risks that could have otherworldly payoffs. Again, not financial advice, but I have been rooting for this exact scenario. I've been eager to see Tesla hit 175, 150, and even lower. As I said, I have time on my side and I'm fully convinced the time is coming when Tesla does deploy robotaxis and does actually ship Optimus bots to third-party companies at scale. It may be another few years of waiting, but whenever even one of these two events happens, it's going to entirely change how the world views Tesla and Tesla stock. We may have another year or so before the market starts pricing in valuation for the next-gen platform, which leaves us in this in-between growth wave phase. I know it's painful for some that need Tesla to perform right now, and to those of you in that scenario, I really do empathize with you. But it's also true this is potentially the last window of acquisition at prices sub $200 that we may have. I of course remain as bullish as I've ever been for the long-term Tesla story, and I can remain this way while also being realistic with short-term expectations and pointing out things Tesla could have done better to potentially be riding in the green these past few weeks as the market has hit all-time highs. You know what they say though, one man's trash is another man's treasure, and everyone selling their Tesla they view as trash right now for the next year or two is wildly valuable in my eyes. I did buy shares today and my plan is to continue buying all the way down each time Tesla stock falls another $10 increment. That's in addition to my monthly DCA amount. I said last year I was building up extra cash reserves for this exact moment and I wasn't sure if we'd get it, but it's here. Not to throw salt in the wounds of those needing Tesla to appreciate now, but I'm genuinely pumped we may get another shot at $150 Tesla stock. To land the plane, I hope I was able to convey the message that having sober expectations in the short term can still be paired with hyper conviction and bullishness in the long run. Being a Tesla bull does not mean trying to spin every negative into a positive or brushing anything negative under the rug and continuously moving the goalposts to cope with the times that Tesla comes up short. Based on everything I've seen from the Tesla community and the public the past 24 hours, I felt as though this was the message that was most needed. One that can come to terms and grasp the short-term expectations shifting down while maintaining the ability to see the bigger picture clearly. This window of opportunity will not be here forever, and it may not even be here for long, but it is here right now. As I've said many times in the past, I'm in Elon's camp. I see a path where Tesla becomes the most valuable company in the world eventually. For me, that path is as clear as it's ever been, but nobody ever said the path was going to be straight up.